With a lot of questions being asked about the recent uptick in volatility, the debate around the switch between growth and value has returned. But why now? What's caused the shift? And how long will the shift last? And what are the arguments for each area of investing? Welcome to this edition of IG Trade in the Markets podcast. I'm Jeremy Naylor. Today we're discussing how to invest in the current market environment of rising inflation, rising rates, and rising geopolitical risk. For this, we're joined by Sean Markowicz, global strategist at Schroders. Sean, welcome to the pod today. It's great to have you on board.
Thank you.
Before we get into the current investing environment, which I'd like to get your thoughts on in just a couple of minutes' time, let's begin with some very simple, straightforward questions. What is value investing against investing for growth?
So value stocks are companies that are trading below their perceived intrinsic value, whereas when investors talk about growth stocks, they're referring to those that are expected to deliver above average profit growth. And so those tend to trade at a relative premium. So when investors are betting on values outperformance versus growth stocks, they fundamentally believe that value companies will re-rate towards their intrinsic value, while growth stocks will de-rate.
In terms of value stocks, is this where dividends appear? I mean, do we, as investors, will we expect to get dividends in the value area?
Value stocks do pay higher dividends because these are fundamentally mature companies that have achieved peak growth rates, so they're returning cash to shareholders, whereas growth companies, they want to reinvest the extra profits that they're generating into the business rather than paying it back to shareholders. So you'll get a lower dividend from investing in growth stocks, but the hope is that you're exchanging that potential dividend for higher profit growth in the future.
Okay, as I said at the top, we've got this shift around at the moment in the markets. To what degree is the current environment I described above bringing about this shift between growth and value? And has the bull run its course naturally? And is that what's happening here?
Well, we've seen a huge move in the performance of value versus growth this year. I fundamentally believe the catalyst has been almost certainly the large upward move in market bond yields as central banks have signaled they're preparing to hike their policy rates. But to be clear, both value and growth equities are down this year in absolute terms, but in relative terms, value is still beating growth by, say, over 10%. So had you been overweight value and underweight growth, you would have been doing relatively better than the vice versa. And I guess the question is, why have growth stocks fallen so much more than value? Why has the response been so much more acute for growth in response to the increase in bond yields? Well, it really comes down to the fact that growth stocks, unlike value, they're expected to generate the bulk of their profits in the distant future, as I mentioned previously. So their valuations are going to be much more sensitive to changes in the discount rate that investors use to calculate their current market value of those future cash flows. So all else being equal, when bond yields increase, value stock prices should perform relatively better than growth stock prices. I don't think actually that the rising inflation environment that has manifested in the past year is really responsible for the rotation. Inflation has been rising since last summer, and since then, growth stocks have actually been doing relatively well. They've been outperforming. So it's I think little to do with the inflation environment, and this may be due to the current sectoral composition of value and growth indices. So value stocks primarily composed of financials and industrials, which don't have much pricing power to absorb the impact of higher input costs. Growth stocks, namely IT companies, they tend to have low fixed operating costs, stronger pricing power. So I don't think any change in the inflation environment is likely to have an impact on the attributes of value and growth investing. Interest rates, on the other hand, are more likely to have an impact.
In terms of where interest rates are going, even with current expectations, possibly of 50 basis points from the Fed at the back end of March, and possibly for something like around about a full 1 percentage point up by the middle of the year, rates are still relatively low, aren't they? Do you think in this context, and rates have been so low for so long, do you think that the low rate environment has pushed markets up generally to beyond levels that one would normally expect at this part of the cycle?
I think the move that we've seen in the bond market and the interest rate levels at particularly the longer end of the curve are relatively high compared to where we are in the current stage of the market cycle. The market has gotten so far ahead of the curve and the central bank view of where policy rates are heading that much already is priced in. There was an extreme move, a very rare move, we would say, a 2 standard deviation move. So quite a rare move in the bond market in January. And so I don't really foresee much further potential for yields to increase from current levels. I mean, they'll probably go up a bit more if the market thinks that inflation is not going to come under control as central banks start to hike interest rates and tighten their belts and financial conditions. But I think that the huge correction that we've seen suggests to me that investors have to a certain extent missed the boat. And while that is the case, interest rate changes aren't the only catalyst, though, that can drive these kinds of rotations. So I think we're going to have to probably wait for the next big move in order for investors to jump on board the value bandwagon.
So when you say the next big move, up or down?
Probably up. I mean, so one economic indicator that I tend to follow that signals rotations from growth to value is when profit growth reaches an inflection point. So in the past, value stocks have tended to outperform growth by around 6% on average in the first 12 months after profit growth bottoms. And this makes sense because when profit growth is scarce, investors are going to pay up for the faster growing companies in the form of higher price earnings multiples, more expensive companies. But when profit growth is relatively abundant, or at least expected to be, investors are going to be more choosy about those valuations. So they'll leave growth stocks to derate as cheaper stocks swing back into favor. So looking ahead, profit growth is already expected to decelerate sharply this year. We had a great year last year. It's already coming down as of January. It's already started to decelerate. But we could see a rebound in the second half of 2022 if inflation proves transitory, if interest rates stay anchored, and if the Omicron-related disruption fade. But of course, none of these things are guaranteed. And as we may come onto this later, the risks of stagflation are increasing. The risks of inflation remaining relatively elevated are increasing. There are a lot of, I think, macroeconomic risks that, to me, suggest that the signals for investing in equities as a whole, regardless of whether it's in value or growth, are somewhat uncertain. And I think from this perspective, although I think the outlook for value versus growth remains positive on a long-term basis, I think the catalyst for a secondary upswing is still somewhat uncertain because we don't know when we're going to reach that bottom, when a lot of these macroeconomic headwinds are behind us.
That's an interesting point because as a global strategist, you have a big picture view. Are you concerned that with an aggressive Fed, we could see liquidity dry up and the market hit a massive air pocket where no one wants to buy? Anything, growth, value, momentum, whatever you choose to look at in terms of your investment strategy, do you feel that there is the potential possibly from this point, despite the fact we've already seen a bear market, I know from for the NASDAQ, the ultimate sort of growth index, I guess. Do you think there's a danger that we could yet see more hefty declines?
I think that the possibility of a market trading sideways for the next 6 months is increasingly likely. I don't think the impact of tighter financial conditions is likely to become exacerbated as interest rates actually start to rise, namely because it's already been priced into the market. I think what would further exacerbate the downturn is if we see evidence of a proper economic slowdown as higher inflation starts to hurt consumer spending, higher interest rate costs start to hurt loan growth, and the economic data suggests that the economy is unable to observe the impact of those two factors. That could then send earnings which the market is basically completely reliant on at the moment, to slow down. And so since investors are expecting most of their profits to be relatively strong this year, any kind of change in those expectations, I think, could start to send the market even lower.
Let's bring in this most recent development, and that is the heightened geopolitical risk around Russia, Ukraine, and the flow-on effects of that. Of course, this builds into this idea about inflation and so forth with wheat and oil prices and so forth. What are your thoughts on that? Bring that into the mix and explain how that's going to make itself felt across the entire market, not just necessarily growth or value.
So I think under normal circumstances, the market wouldn't be as worried about these kinds of geopolitical events because the investment community tends to overreact, and we tend to see kind of a post-recovery period once a lot of that geopolitical risk fades. We've seen that with the trade wars in 2017, et cetera, a lot of the US-China relations. But I think this time is different because we are already in quite a vulnerable economic environment where inflation is already at record high levels, not seen since the 1970s, where interest rates are poised to rise in order to try and reduce the level of inflationary pressure. And now we've just experienced another headwind, which is that the Russian invasion is likely to result in more economic sanctions against the country. And that's a concern for investors because Russia is such a big exporter of so many raw materials, base metals, and commodities that the world is reliant on. And with inflation being highly driven by those commodity prices at the moment, this is just going to add more fire to this basket of problems that investors are confronting at the moment. And so with higher inflation, investors are now trying to grapple with what are the asset class implications of this higher inflation environment, because most of our base case scenario for the rest of the year was that inflation was going to moderate. That no longer seems to be the case.
So does that therefore mean that if there is all these facets conspiring together to bring about a further leg down, do you see a continuation of what we have seen so far, and that is that growth takes the brunt of the sell-off and value remains relatively well bid or not as badly hit? I mean, we've seen good evidence, I think, haven't we, with the FTSE 100, which I think I'm right in saying is more value than growth. And that has held up better than most other indices. Do you see that sort of situation continuing? Or do you see, if we have all these events coming together to conspire to bring about a catastrophic reaction on the equity markets, do you think then all bets are off for everything?
Yeah, I'm afraid it's the latter camp. I mean, I find it very difficult to imagine a scenario where economic growth is slowing. Interest rates are probably going to stay level in that environment because you just see a lot of safe haven demand for fixed income. No one's going to be buying value stocks, even if they appear cheaper than their growth counterparts, because value companies, as I mentioned earlier, they really need that profit rebound in order to lure investors. We kind of need all the stars aligned, I'm afraid, for I think value to outshine its growth counterparts. And part of that is going to come from a change in the interest rate environment, but that's already been priced in with the huge move in bond yields that we saw in January. Investors are, I think, going to have to look forward to the next catalyst, which is, as I've mentioned, probably going to be, once a lot of these macroeconomic headwinds are behind us. So in that environment, I'd say, stay invested, but I wouldn't be choosing one style of investing over the other because there's just too much uncertainty at the moment.
What do we know from history? One final question has to be to gather us all together to work out where we're going to go from here. What do we know from history in terms of some of the downturns, the 87 Big Bang, the 92 recession, the dot-com Y2K event around the turn of the century, great financial crisis? What do we know about the pullback in the markets like that? Do we have any lessons that we can bring over into where we are at the moment and suggest that this might be vicious but quick, and then there's an opportunity to buy back? Or, as you suggest, do we think perhaps maybe the events that we have at the moment will just mean we just travel sideways for the next 2 years?
Well, I mean, it really comes down to your investment horizon, and most of us are long-term equity investors. I think it's fairly understandable for many of our investors and your listeners to react emotionally to some of the headlines of markets selling off and respond in a very kind of negative fashion by selling their market exposure. But actually, most of the historical analysis that we've done suggests that staying invested is so important, because if you miss anywhere between the top 5 to top 10 best days in the market over a year, you're missing out on probably a big chunk of your returns. And so trying to time the market of when you think things are going to improve is so notoriously difficult. So our, I think, suggestion would be to, try and look past the noise. Throughout history, there has been so much geopolitical risk, but I don't think we're really at a stage where World War III is starting, where we're entering into a period of structural macroeconomic turbulence. I think that there's going to be some stagflationary pressure, so a combination of slowing growth and inflation, because we're going to see higher inflation remain with us for the next 6 months at least. But despite that, I think that with COVID being the primary driver of the downturn that we've experienced over the past year, and with that, at least to my mind, remaining something that we're able to overcome with vaccines, I think the overall outlook is still going to be positive. So I would say stay invested, try not to give into the temptation to sell.
A nice positive note to end on. Look, Sean, we'll have to leave it there, but thanks indeed for joining us. It's been a pleasure. Sean Markowicz is global strategist at Schroders, joining us today for the Trading the Markets podcast. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.